So some examples of scenarios that might actually trigger you wanting to think about your superannuation carry forward cap would be a common scenario that many Australians come across, which is the sale of an investment property. So let's say you bought an investment property for $500,000, you held it for a period of more than 12 months, and you eventually sell it for $1 million. And let's just assume that you're on the top tax bracket, just for easy maths. So you've bought it for $500,000, you're going to sell it for $1 million. $500,000 of that gain is taxable. You get the 50% CGT discount, and so $250,000 worth of the gain is added to your taxable income. Now in this scenario, you're already on the top tax bracket. That $250,000, you're going to effectively lose 47% of it. So approximately $125,000 worth of tax is now payable as a consequence of the sale of that property. Well, you've just come into a large portion of capital. You've also probably come into a very large tax debt, like in that scenario. So you've got this capital, you've got this cash, and you've got this tax debt. Well, if you also have built up a carry forward concessional contribution cap, it might potentially be an opportunity to utilize some of that capital, push it into the superannuation, decrease your taxable income, and therefore decrease your tax. So in this scenario, if the individual in question contributed $100,000 of that capital that they had from the property, that would decrease the taxable income by $100,000, and therefore the income tax return that they would get would be $47,000.